Students, aloha.
Aloha.
It's good to see some of you here tonight. I understand there's lots of other things going on. Sound of Music just started. I'm sure that took away a lot of people. But it's a thrill to be here to talk about the wonderful world of cash flows. And we'll see if we can't make them fairly interesting tonight. Brother Tanner explained how to get to the various templates. You just hit play and you come up with the, do they call them buttons? The triggers that open up the templates for both social entrepreneurship and business, and the rules and regulations, and the interactive cash flow and income statements.
Play shows a video.
Oh, that's right. That's right.
Click the plan button.
That's right.
Plan button.
That's right. Where's my cursor? There we go.
Play's interesting too.
So this is where you go, and you can click on any of those 6 places, and they seem to be working. Our our interactive Excel spreadsheets seem to be working, and we'll turn to that in just a minute. Just as kind of a starter, I've put some terms up here that we'll talk about a little bit tonight. And to start off with, we have the good old faithful journal, accounting journal. Need a thicker pen here. When you start the accounting we're going to talk about tonight, you need to start with every cash flow in and cash flow out. Every receipt you've gotten, every expense you've paid, anything that's come in or gone out, like a check register. You just write it down in order by date. And there's a second step if we were real accountants, and that would be to transfer that to a ledger which combines some of the expenses into smaller groups and actually have numbers that are often standard numbers for the whole accounting profession. But we won't do the ledger, and we'll just talk about the journal. So when you're working on your plan and you're trying to estimate what's going to happen in the next year, which is what we've asked for in terms of a cash flow. Do a journal, write things down so you can, well, depending on how complex your plan is, do a journal, or you can go, of course, right to the cash flow. And just speaking of cash flow, let me give my cash flow speech. We really concentrate in these business plans more on the cash flow than on net income and balance sheet. For one reason, some of the companies don't last long enough to get to a balance sheet, a meaningful balance sheet. But the cash flow is something that you need to have your fingers on. As a startup company, you need to know where the money is. You don't want to buy a piece of software that takes care of that for you and just leave it up to the computer. You want to know yourself, as the idea guy, as the entrepreneur, what is coming in every day, every week, and how you're doing on your budget and drawing down your line of credit. So the cash flow is really important, and that's becoming more and more recognized kind of in the financial industry, whereas income, after-tax income per share for years and years has been one of the measures of comparing stocks. More and more the analysts are going to free cash flow per share, because net income has some elements that are that don't necessarily equate to cash. They equate to tax policy and things that are a little extraneous to value. So cash is king and cash flow is king in the entrepreneurship world. Let's turn to the cash flow statement, if I can find it. Yeah, there it is. So there's our cash flow. And this is really a very simple document. We start out, these are fictitious numbers, of course, and I just put the numbers in so that we can see the action of it. It doesn't come with numbers. You supply the numbers. So we have a company name is the name of the company. Oh, great.
I think that might work.
Yeah, will that work?
Well, it was working a second ago.
Ah, okay. What do you press right there?
Yeah, that helps.
Oh, wow. Okay. All right. So we assume that there's an initial capital investment of $5,000. That's cash in. We bring it down here, and that is the net cash available in time period 0. So that's what you've talked to your parents out of, or you've maxed out all of your credit cards and friends, and Uncle Ralph, who has a service station in Irvine, and got enough money to start. Then we put the receipts up here, net sales of product 1. We could have made this, of course, very intricate and complex, but just putting a couple of numbers to show what the cash flow does. Total disbursement, we just put in those numbers again. And you see the effect of the cash flow statement. Started out with 5,000, made 1,000, paid out 4, so you have a decrease in overall cash, and that is the amount of, that's the cash that you have available going into the third month, or to the second month. Well, this is certainly not untypical. You don't expect to have a lot of receipts the first month that you're in business. As a matter of fact, it's amazing to have any receipts in the first month in business. But this guy was really good. Then we go to the second one. Receipts are up a little bit, but we still have a negative cash flow of $2,000 that month, and that zeroes out our available cash. So right off the bat, 2 months in, we need to go talk to the banker. Actually, we saw this a few weeks ago and saw what it was doing, and we've already talked to the banker, and we've shown the banker this cash flow, and he knows that we're going to need a line of credit along about the third month. So let's see, I didn't actually show the loan up here, but if we if we put a loan up there, let's see, how large a loan do you think we should get? Certainly 4,000. Any more than 4,000? A little walking around money, a little money in the till, a cushion. So these are all fictitious numbers, but let's borrow $5,000 and see what that does here. Ah, we're positive. Not difficult adding and subtracting. Any questions about that? This is, of course, really simple. But when you're doing a business plan in an academic setting, you don't have to have a really complicated cash flow that you're trying to trace out here. But and this is what the entrepreneur looks at very closely. The monthly cash flows, he's arranged to stay positive with his loan from the bank or his loan from mom and dad, and he's often not making money yet, but not losing money either. But that's kind of beside the point. So that's the cash flow. Any questions about the cash flow? and how you use it. We've asked in the plan rules and regulations that you do this cash flow, which is 1 year, 3 months, and then 3 quarters. So just 1 year's worth of cash flow. And this is a working document. This is a living document. In real life, we would come, let's see, all right. Can you see that laser? Help. Ah. Right. We need a battery company. Okay. As soon as you see, as the entrepreneur sees what's happening here, he goes back and does, this is looking forward. We're here at time period 0, and we built this pro forma cash flow. Pro forma meaning projected. Well, after we've done the first month, we've just put in the real numbers, and now we're changing it. That's the one thing that is certain about entrepreneurship. You won't be using the plan you started with very long. You'll have a plan B, C, D, or you'll be trying to get out quick. Or you'll be Facebook. We're expecting a lot of Facebooks. So it becomes a living document, and as you go forward, as we have, we've mentally gone forward here, we put in the actual numbers, and that allows us to plan ahead, decide to do something with our marketing, maybe get more money from the equity, more money from the investors, so we don't have to pay interest on the loan to the bank or whoever we got that loan from. And this line, just to put it in the context of some of these acronyms up here, this line represents Ebitda, or net operating income. Those two are essentially equal. And this is just a vocabulary point. If you are presenting to a sophisticated angel investor and he asks you what your Ebitda is, that's a real hot term these days among investors. What's your Ebitda? Well, what would you say? Before tonight, you look at your finance guy, earnings before interest, taxes, depreciation, and amortization of the loan. And the reason that a lot of investors like to see this, and this is the net operating income, so it's before depreciation, it's before taxes, and it's before any interest, no loan. The investor wants to see the cash flow stream that he or she is buying without any things that are a little bit extraneous to his or her return. She wants to see the cash coming in, not the tax benefits, not the tax, the cash. Because the investor doesn't know who he or she is going to flip it to. They may not have a tax appetite. They may not care about depreciation. And they may not borrow anything. It might be a full cash investment. So that's what they want to see, is pre-tax cash in hand. Any questions about that?
Yeah, what was the A again?
Amortization, which just means the principal and interest that you pay on a loan. You amortize a loan over time. It's an installment basis. That's the same thing you do with your mortgage. You amortize it over 30 years. Okay, any other questions on the cash flow? Well, that was easy. Okay, on to the income statement. And this is really handy. It's just on the same sheet, essentially. There is a sample income statement. Let's see if we can get it all on the screen. Not quite.
And maximize that window. On the inside?
On that?
On the inside?
Oh, on the inside?
Yeah, right there.
Right there?
Up to the left.
There?
Up to the left a little more. Right
There? Ah. I always wondered what that was for. Okay. Still doesn't quite give us everything, does it? But here again, what we'd like you to do is, after you've done your cash flow, link the cash flow to this income statement. I don't know. We have an accounting professor here who could tell us, you know, are there people that just like different statements more than others? I like cash flows. I'm a cash flow nut. But I want to see how the cash flow mates into the income statement. So make your numbers match, which shouldn't be hard. When you get to the income statement, you do have a few items that we didn't have before. Well, I don't have them in here. You're going to be having some non-cash expenses like depreciation. Trust me. So if you bought a car, a copy machine, a building, you depreciate that over time, which means that you can deduct the cost of a building or some capital asset slowly over time, and you put that on your income statement, which becomes an expense and which will lower your operating income, and basically your taxable income. Still haven't got the bottom in there. So if we added depreciation in there, it would lower our taxable income, decrease the taxes that we pay, but it wasn't a cash flow. It wasn't a cash flow out. It might have been if the rent on the copy machine actually equaled the depreciation, but we have suggested in the licenses, taxes, and fees line there, just use 20%. I've seen a lot of plans, business plans, in the last couple of semesters, and not one of them had federal taxes in it. I don't know what was going on there. Did they think there was going to be a ferry just kind of take them under the radar? They had the Hawaii excise tax, which is 4.5%, but no federal tax. So we just for purposes of making the plans equal on guessing what taxes are, just use 20% as a basis. On the anything that isn't in that area, though, that you can estimate from actual numbers, do so. If there are certain fees that you wouldn't consider putting in there, or rentals, find out what it costs to rent an office machine and a building and a truck, and try to use real figures. Nobody will check you on that, but just make this exercise as realistic as possible. Yes, ma'am.
20%, where do we take that from?
Just the convoluted mind of Wynne Johnson. It's
She's asking 20% of what?
Yes.
oh, I'm sorry.
Is that right?
20% times taxable income, which is right here. Oops. I'll just wiggle the cursor. Or that. I still don't have the bottom on this. Let's see. Now this was taxable income. We call it operating income. They're the same if you don't have any depreciation or interest in the formula. So it's 20% times operating income. And presto, the program does it for you. All this difficult adding and subtracting. So make this match the cash flows. Ready to move on? What's any other questions on that?
President Johnson, where will we find those data about like the taxes in Hawaii, the taxes on federal? I mean, I'm guessing it's just Google, but is there a website in our homepage on Hawaii or something?
Well, that's why I've just given you the surrogate for taxes and licenses. Just if you don't like the surrogate, want to actually find the numbers, that's okay too. But you'll have to. We don't have those in one place. You'll have to look at the federal code and look at the Hawaii tax code, and look at the cost of a license, which incidentally, a business license in Hawaii is $47. And you can save your name for $2. So about $49 you can secure your name and get a business license. But then state tax and federal tax are going to, you're going to have to find those, and they're going to be subject to a volume amount. You know, how large are you expecting your income to be, and the rate will change. The maximum federal rate right now is 35%. And Congress is trying to lower it.
So basically do your own research.
If you don't want to use the 20%, yeah. And you'd get better marks for doing the actual taxes than my surrogate. So there was another question. Yes, sir.
Where do you recommend we incorporate our business?
Where?
Yeah, where? Like, should we do it in Hawaii or which state do you recommend?
Nevada, Wyoming, no state tax. Other than something like that, where are you going to run it? Are you going to go home to Utah and run it, or stay here in Hawaii and run it?
I'm from here, but my wife's from California, so we're thinking of going there. And my company would do better there, I feel.
Yeah.
Being located there.
Well, I think you'd want to use the state where you're going to be domiciled, because there might be some grants and some tax credits that will be peculiar to that state. Like California has great tax credits for solar power. If you put solar panels on your roof or on the top of your office building, you'll get some great credits. Whereas Hawaii doesn't. I don't think Hawaii has that for personal homeowners.
65%.
65? Okay, I was wrong. Thank you. Anyway, I would look into that. These days, there are big differences between the states of credits and deductions due to greenness, green energy, lots of insulation, planting trees for shade, those sorts of things. So you'd want to be able to take advantage of that where you live, I think. California is not very friendly towards business, would be my only caveat there.
So it'd be worth starting out in one state and then changing the location of the company?
Yeah, I think that's fine. I think if I were you, I'd start in Hawaii and then see where you move to. It's, it's a little silly sometimes to incorporate in Nevada and not know anything about them, but there is no state tax. And you could go there and save yourself a lot of state tax on the $5,000 you're going to win. Okay. Any other questions on the income statement? Okay. The balance sheet. There are a lot of friendly faces out there. I think I've taught some of you these concepts 3 times. 2 times today. So I'm glad there aren't a lot of questions. Balance sheets. The balance sheet is kind of a still picture of your company at a point in time. how much cash do you have, how many accounts receivable you have. Does everyone know what accounts receivable are?
It's a short term of money you don't have now, but you will receive in time.
Right, okay. You've sold something on terms, essentially on time. Someone has bought one of your products and will pay you in 30 days. And so that becomes an asset and becomes an account receivable. The inventory, that's self-explanatory. Prepaid expenses, what would that be? Could be insurance. You pay for insurance sometimes in advance, and so it becomes an asset because you can, if you turn your insurance back in, you get part of your premium back. You could put that in there. A deposit with a vendor on some great deal the vendor's going to give you, but he wants a deposit to make sure that you'll pay later. Property and equipment, leasehold improvements of workplace. What is that? When you start this company, you don't want to buy very many things. You want to lease them, rent them, so the cash flow is as low as it can be. And that means that you...
Cash outflow is as low as it can be.
What did I say, cash flow?
Cash flow is as low as it can be.
Well, it might be too, that might be true too. Yeah, your cash flow out is as low as it can be. So a leasehold workplace, in the workplace you lease up this empty space, this empty store that is next to the grocery store in the shopping center for $5,000 a month, and you put koa wood paneling in there. Really expensive. I mean, you're gonna start this company just in style. That is your leasehold improvement, and it's an asset. Vehicles after depreciation, good and other assets. Patents, those are valuable. What the value is always, you know, up for argument or negotiation. But you can have a third party appraise your patents, appraise your formulas. Any of your intellectual property can be appraised and put on your balance sheet. Goodwill. Could we have an explanation of goodwill?
An entity that is not necessarily tangible, or that is not tangible. For example, with Disney, Mickey Mouse is probably a pretty good example of goodwill. It's something that is representative to the company and is it's kind of a hallmark of the company. For example, if they were going to sell it, you would actually put a dollar amount on the good that Mickey Mouse will do for, like, what it contributes to the company.
I think that's kind of more by way of a trademark, or almost not a patent, but a trademark.
Isn't goodwill mostly just people knowing who you are and knowing how good you are at what you do, or how good your products are? Like it's the favor that your name finds in the public eye.
How do we value it? How does it end up on a balance sheet?
Goodwill usually comes like if you buy an existing company and there's a value placed in that company, and then you add that company's former value into your books.
Okay.
And that adds to your goodwill.
That's a good place to end up with some goodwill. Goodwill is usually, it can go in a balance sheet, but it's a little fluffy. You know, you in a fire sale, if you were going bankrupt, you'd have a hard time getting much money for your goodwill. Yes, Travis.
Where would you organize, like, if you made a contribution to a political campaign or something like that? Where would you organize it on your sheet?
It's not a deduction. It's not like tithing. It's not an expense of the company. You just don't put it anywhere, I don't think. unless you need to put it on your records just to meet the requirements of the election laws. Does that kind of answer your question? Okay. Any other questions here? Well, try here again to match this statement with the income statement. So you're trying to integrate the cash flow into the income statement, and we've asked that you do an income statement for the end of the first year and for the end of the second year, and a balance sheet for the same time. So a balance sheet a year down the road and 2 years down the road. Yes, sir.
Brother Johnson, if I could just clarify something. I think one of the challenges some students may have as they listen to what you're presenting here is that these financial statements that you're creating are for a different user set.
Mm-hmm.
What some of them are learning in Accounting 201 is for external financial reporting, which follows accrual accounting.
Yeah.
But what I see you putting together here is more of a cash basis type of accounting.
Exactly.
So,
yeah.
Like your question on a donation, you know, under accrual accounting, we would have to record that as an expense because it really does come out of income and stuff like that. But what you're talking about, you're more looking at
business expenses.
Yeah, it's
rather than.
I think you are answering that from a tax perspective, maybe, because you can't deduct donations on your tax return. And that's why you would leave it off your tax return. But under financial accounting, you have to deduct it. So it's kind of.
Yeah, and
it depends on who you're reporting to
yeah.
and how he's going to answer this question.
Yeah.
So what you hear in my class is going to be different than what you hear in here because they're two different sets of people reading the reports, and so they're developed differently.
Yeah, thank you. Actually, from a practical standpoint, if it's the company giving money to a candidate, that's cash flow out of the company. So that certainly would be on the cash flow statement. Thank you for that difference.
It's also good to remember this is all speculation of expected things that will happen in the future.
Yeah.
So it doesn't have to be exact.
Exactly. Thank you. And your point was also well taken. We have an audience of maybe one angel investor, a nice 65-year-old guy who's retired and has a lot of money and wants to help out students, and so he's looking at business plans.
Use the microphone.
Oh, I'm sorry. Can't you hear me back there?
Well, it's a little bit hard to hear.
I'm sorry. Now can you hear me? Okay. Let's see. Where was I? The audience for our presentation is someone we're trying to get an investment from, and so how do I put this? Sometimes you want to be as simple as you can, you know, not have a really complex statement. But what you do want to do, and moving on from the statements, as I have written over on the board, show your assumptions. Any potential investor worth his salt is going to want to know where these numbers came from. Did you look up some national statistics? Did you interview owners of other small businesses in your community? If you put a loan in there, did you go talk to the banker and see what they're charging entrepreneurs these days if they are actually loaning to them? And you can find things like that just at your local bank, or even better, look on SBA.com and see what kind of loans you can get in conjunction with the Small Business Administration and your local bank. There are some terrific programs that have been put in place in the last few years. Any other questions on the balance sheet? Well, I think I've taken more than my fair share of time. Just to kind of finish up, well, first of all, someone's going to ask you for the assumptions. Where in the world these numbers come from? Brother Johnson told us to use 20%. how is the investor going to get his money back and when? That's also sort of anybody's guess, but think about how you'd answer that question and maybe put a line or two about it in your plan. And if you get halfway through the first year and you're way off your plan, your product's not being purchased, and your employees all quit because you're too stressed out, what would you do? What's your plan B? How would you protect the investor's money if you had to completely change or even partly change the way you're operating and what you're selling and so forth? What's your fallback? Don't spend a lot of time on that, but maybe a paragraph on what you might be able to suggest there.
Win?
Yes, sir.
On exit strategy, you may occasionally find somebody that just wants their money back, but 90% plus want their money back plus something more. It's how much more. So it's not just when they're getting their money back, it's their money back plus what and when.
Yeah.
So they want interest, or maybe they want a part of the ownership of the company, or what are they going to, you know, what's in it for them is a lot of what's happening when you also discuss the exit strategy.
Right, thank you. Just closing with one example of the opposite side of that, which is the typical thing that happens. We were watching a video in one of my classes, I think last semester, and it was a situation where an entrepreneur had raised $500,000 or something like that from people that he was fairly well acquainted with. The project didn't go well, and he hadn't spent much of the money, so he started giving the money back. Giving it just not with interest, but at least giving the money back. And one investor said, I don't want that. I don't expect that. I'm a big boy. I've signed up as an equity investor. I know that if it doesn't go well, I don't get anything back. Just keep it and stick me in your next plan. And that turned out to be a wonderful result for the guy. But it's refreshing both to see an entrepreneur or a developer who's giving the money back, and then it's refreshing on the other side for someone to step up and say, well, I knew it might be lost. Well, thank you for your attention. Come by our office in the Aloha building anytime and ask further questions. And we have mentors across the way. Oh, okay. Mentor lady.